We're going to be diving into a tax topic today of investing tax-free into startups, operating businesses. As you guys all know, we've made a little bit of an outlet into investing in things outside of real estate. Not that I don't like real estate anymore, but it's tough with interest rates where they are. And you guys have seen the genesis of me as an investor from the start, right? Moving beyond boundaries. And that's what we wanted to get into this realm, bringing on a CPA, Thomas Jones from Sweeney Conrad, a firm out in Seattle, Washington. But yeah, I'm not giving any tax legal advice, as I always say, but today I brought a CPA to arm us with the right information. But yeah, thanks for jumping on, Thomas. Appreciate you helping us out on this.
Yeah, no, happy to join. This is something I'm always passionate about, talking about taxes.
Yeah, and this is a good one, right? Because I think the audience for this are people investing in private equity or business owners themselves might be the use case. But yes, you sent me over some notes and I'll set you up with this. The acronym is QSBS. What is that? And yeah, let's dive through the topic and how people can utilize these things.
Yeah, definitely. So QSBS, I think, is one of the most valuable and biggest secrets in the tax code. It's tax section 1202, so sometimes it's referred to as a 1202 tax benefit. QSBS stands for Qualified Small Business Stock. Sometimes it's also just referred to as founder stock. And what it refers to is for eligible investors of holding eligible stock in eligible companies when they've met the requirements and there's a stock sale. So think about the early founders of some of the big tech companies we see around the area. When they've held the stock and they've held it for 5 years or more and they sell it, there can be a tax-free gain of up to $10 million. And that was recently increased by the Big Beautiful Bill to be $15 million. And some of the other improvements around that happened recently with the Big Beautiful Bill. So it's an area where I don't think a lot of people know about it. Angel investors really like this area. A lot of venture capital investors are also happy in this area because you can structure deals to get a huge tax-free windfall. But yeah, we can dig a little bit more into that.
Yeah, so just we don't lose anybody on the bus here. I think I've heard this come up in one of my angel meetings where the way the angel deals work, at least here in Hawaii, is you'll have a founder pitch everybody and they may need like $500,000. So, guys will put in 25 grand, 50 grand in. But until somebody told me about this thing, I was totally oblivious to it. But I guess what these guys would do is they would take advantage of this types of arrangement, right? In this angel investment, investing in tech investments, but you could also invest in whatever, right? Like brick and mortar businesses. Is there any other use cases out there for people that, other than your standard bunch of angel investors passively investing? Or I guess technically like they're using safe notes is the way they're doing it, but.
Yeah, tech and I would say like medical innovations, a lot of research and development companies, software companies, those are all high top industries that are primed really well for this area of the tax code because any dividends or pass-through income that comes from those investments is not tax-free. It's really about getting a lot of appreciation on the stock and then selling in a stock sale. And then a lot of types of businesses or industries don't want to sell in a stock sale. That's just not what the market wants. They want to do an asset purchase. And so you don't get that tax benefit. So that's why we see those industries more commonly taking advantage of this benefit. But those aren't the only industries allowed to do it. You can have distribution, warehousing, transportation, manufacturing. There's a lot of different industries that could qualify for this tax benefit. There's a small list of, I would call them in general, professional service type industries that aren't allowed to be structured and take this advantage of this tax structure. That might be like legal, accounting, consulting type firms. They wouldn't get this tax benefit in this
like
type structure.
Like these CPA firm roll-ups or like veterinary that
Right.
wouldn't count, or dentists, would dentists count?
Yeah, no. And where you could get creative is if there's technology or manufacturing or distribution related to those. So for example, if my firm, Sweeney Conrad, were to sell, it wouldn't be eligible. But if we had developed a new tax software or if we were working on some kind of program, that could be eligible if it was in a different entity for this tax benefit. So it doesn't necessarily exclude everything related to accounting, it's more the professional services wouldn't be eligible, but the other types of software, manufacturing processes, distribution, that would be eligible for this tax benefit.
So I guess maybe the why behind it is like the government's trying to incentivize people really to change the game in a way, as opposed to just roll up 5 CPA firms and put in a new manager and just get a tax-free incentive off that. They don't want to incentivize that. They want people to go after it and take risks, essentially.
Yeah, no, absolutely. It's nice to see that the government realizes that like small businesses have a lot of potential and a lot of value to add, and they want to provide a leg up for these startups that could change the landscape and improve our technology and make our lives better. But getting fundraising and getting investment is hard enough. And especially when investors can choose a more stable return that is backed by hard assets and maybe also has good tax benefits like investing in real estate, it's hard to compete with that investment. So I think that's why the government created this incentive. So startups that would inherently be riskier can still take advantage of this. And while I don't want to dive into it here, there is a corresponding tax benefit under Code Section 1244, where if you make this angel investment and then it goes south and you lose money, some of that loss could be considered an ordinary loss. But that's a different conversation for a different day.
Yeah. Yeah. Which in some of these types of investments, especially angel investing, the majority of the time, it is going to be a complete wipeout.
Mm-hmm.
So before we move on, like something I'm getting hung up on is you keep saying the word stock, right? So like in some of these tech investments, just to use as an example, the name of the game may not be to like sell and create an IPO, go on NASDAQ, go on that platform. But does this still count if, say, we're buying some, I guess you're saying like we can't just do some of these business, I'm thinking like e-com or SaaS business, those apparently don't apply. But say we're making a new pavement machine or something like that. And then our goal is just to sell it to industrial products behemoths in the civil engineering world. Is that still stock? Or is that, to me, that's just a sale acquisition? Does it still count?
Yeah, no, that's a really good question. Going back to the business school basics of how sales are structured, you can either acquire the assets directly, so it's an asset purchase, or you can acquire the stock of the entity that holds those assets. So that's the stock purchase. And there could be reasons for doing one over the other. Sometimes with the stock purchase, you might be inheriting certain liabilities that you don't want. One of the benefits of doing a stock purchase is you also acquire the operations and the payroll. Whereas if you're only purchasing that equipment, like you'd mentioned, there's still probably a team behind that who developed and maintain that equipment and services it. If you're only buying the equipment, now you've got to hire that team over. And so there could be different operational challenges for that kind of merger and acquisition. And so to get the advantage of this tax benefit, the reason it has to be, and I don't know why the government decided it has to be a stock sale, but one of the ways that a seller, where the company meets all these requirements and the investors would get this benefit, they would be pushing for a stock sale because they would get that tax benefit. If they just sold the underlying IP or the underlying equipment in an asset purchase, the buyer gets a better tax answer because in an asset purchase, you also get to step up your basis. In the case of like buying equipment, you get to depreciate it really quickly. In the case of IP, you get to amortize it over a good 15 years as goodwill. In the case of the buyer buying stock, there is no amortization. There's no depreciation for that. They just have basis in the new stock. So for a buyer, usually they want an asset purchase. For a seller, in this case, especially when QSBS is involved, they really want to sell it as a stock sale. So that way they get that tax benefit. And there could be some negotiating to meet them in the middle as well. But hopefully that distinguishes between asset versus stock sale a little bit.
Yeah, still a little fuzzy. Maybe it's just a formality, I'm thinking. But okay, so I'm just a dumb real estate guy, right? So when we buy like 100, 200 apartment complex, that's the asset. I think when we divest of an investment, we typically sell the asset. But we always, when we're in operation, we have the LLC over the asset. The LLC owns the asset. I have seen other people out there, and maybe we've done this a few times where we've sold the LLC that holds the asset. I know that was always a little game in Texas where Texas doesn't see it trades hands, so the property taxes doesn't explode on you for a while. But I don't know, could you equate it to some sort of that mechanism in a way.
Yeah, definitely. That's a great example. So in the case of real estate, almost all the time, 99% of the time, there you're selling the asset. You're not selling in the case of an LLC, you're not selling the interests or units of the LLC when it's appreciated and gained value. But you are actually selling the stock in that LLC or the interests when you're doing the fundraising, right? Because the investors, they're putting money in exchange, they're getting stock. On the exit side, there could be a strategy. Let's say the fund wants to roll over the gain into, and let's say a REIT, and all the investors are in agreement that they want to do that too. It could be the case that like a big REIT or some big institutional investor comes in and they say, we're going to just buy out the LLC. We don't want to deal with changing over operations. And they probably wouldn't. There could be reasons to do that, or a lot of reasons not to do that.
Most reasons not to do it.
Yeah, it would make more sense if there was, I would say, more services and a big team of employees that were providing hands-on services that would make sense to transition, and be hard to do that if you just an asset acquisition. But real estate's pretty clean. You've got your property management company that's third party that's handling the maintenance and operation of the building. So you're really just selling land in the building and the improvements when you just do the asset purchase.
Yeah, where this is like going back to the new age concrete laying machine, you have the IP, you have probably some equipment, and then that all is packaged inside that LLC, which then you're selling it off via stock, right?
Yeah. And there's also, this gets really into the weeds, there's also ways to buy the stock of the company, but treat it as an asset purchase for tax benefits. So a lot of creativity. There's a whole area of expertise around mergers and acquisitions, and that's where I like to play in.
Yeah, so it's funny, sometimes when you're in the real estate ecosystem, you don't really hear about this type of stuff. But, when people know what's up, everybody's doing this thing. And yeah, I just heard about this. So another thing is it needs to be a C Corp too, right? That's why you work with the right accountants to just set this stuff automatically up for you. But any other kind of rules, like do people need to know they're going to be exiting like this to do anything on the front end other than setting up as a C Corp or?
Yeah, there's over a dozen different requirements, and some of them are on the company or the investment side, some are on the investor side. And so for investors, one of the things you need to keep in mind is the stock that you're getting. Usually you can ask the company or the fundraiser, is this founder stock? Is it QSBS eligible? And they can usually say, yes, we're planning that this group of investors will be eligible for that tax benefit. One of the requirements as an investor is that you're also getting the stock at original issuance. That means it comes straight from the company. If you're going to your friend and he works at this company, hey, I'm one of the founders. Do you want to buy some of the stock straight from me? That's a second party purchase. You're not going to get the tax benefit because it's traded hands. It's not original issuance. One of the core requirements on the back end to get the benefit is to hold it. Used to be for 5 years, you have to hold it to get the 100% of that benefit, that $10 million exclusion. Recently, with the Big Beautiful Bill, now they reduced it to 3 years. You now get 50% of that benefit, 4 years, 75%, which is really cool because sometimes, especially with angel investors, a lot of them go bust, but some of these unicorns, they take off like rocket ships and they don't stick around for 5 years before they've sold to private equity or IPO. You miss out on the whole benefit if you had to wait the full 5 years, which is what historically has been done. But it's pretty cool that now Congress opened that up. So even at 3 years, you're starting to get some vesting into that tax benefit.
From these angel deals out there, when they sell these assets, is it typically an asset sale or selling the entity or a stock sale? Like what's the typical with people doing these?
Yeah, I would say it depends on who the buyer is. In the example you gave with some manufacturing equipment, maybe some IP attached to it, but maybe that startup, there was a lot of bumpiness over the years and employee turmoil, potential lawsuits. That's a great example of where a national aggregator, whether it's a big private equity company or just some national institutional buyer that's going to come in, they'll say, you know what, we love the asset, we'll pay you for the asset, we'll pay for the IP, but we don't want that extra liability or the historical turmoil. That's on you. We're just going to buy the assets. Another reason they want to do that is that they'll get a huge tax benefit on their side by deducting, depreciating, and amortizing the millions of dollars they might pay to acquire that asset.
I'll say one thing there, that liability is huge. I had a buddy, he was going to come into a deal as a passive investor, and they were switching with another passive investor. He didn't realize that the entity was under lawsuits and stuff like that. And no wonder like the other guy was trying to exit his position. So he went into that unknowingly. But yeah,
Thanks.
sometimes it's good just to throw the baby out with the bathwater, or the entire bathwater in a way, and just sell the whole thing. But sorry, go ahead. Yeah.
Yeah, no, and that stuff does happen. And regardless whether it's an asset or stock purchase, there is a certain amount of reps and warranties. This is in real estate too, I would assume. Reps and warranties that are being made by the seller, and there's some contractual opportunity for the buyer to go back after these liabilities that come up after them. But yeah, it can be a little bit cleaner to do an asset purchase, is what I hear from attorneys. For these tech companies where the founders and angel investors are getting this QSBS tax benefit, they'll definitely be pushing for a stock sale. Also, the type of buyers are more likely different. It might be late stage fund, either venture capital, private equity, that maybe their exit strategy is to take it public. It could be that their exit strategy is to do a reverse SPAC out into the public market, or just to IPO. So those strategies all would be easier to do with the stock. Also with stock, sometimes it's easier to do a reorg into a new structure. So it could be that to provide liquidity to the founders and to buy them out, like in a case of a reverse merger into a SPAC and then going to the public markets for funding, what that would involve is that you're going to have a few different reorgs, possibly into some new holding and new management companies. C Corps, you can do some reorg structuring there that might be tax-free. In the case of assets, if you're moving assets over, that might not be a tax-free event. So there's all sorts of reasons why you might do a stock purchase versus a asset acquisition. And it's definitely a complex area.
Yeah. So it sounds like from the investor perspective, there's really not much. You can ask the question, is this QSBS qualified? Because the reason I'm thinking, like, I did a couple of these investments, and I didn't know I didn't even know about this thing before, so I would have been known to ask. But I'm just hoping it's really up to the operator, right? Yeah. What does the operator need to do to transition over to?
And it is up to the operator, to the company, to attest that yes, your shares do qualify, both at the beginning, if you're asking about it, or even at the eventual liquidation. Because they really are on the company side. I've seen it structured where they might have like their founder shares, they might have Class A that are also eligible for this benefit, but they might also have another class that is just intentionally by design not going to be eligible because there's some of these requirements they know they might trade hands, so they're not even going to bother with the extra compliance work. It's also common with these early stage startups that they'll have convertible notes. You mentioned safes. And so there could be some planning around there. For example, convertible notes and safes, your 5-year clock doesn't start until you own the stock itself. So if you've got stock options, safes, convertible notes, you've got the potential for it to lead to owning QSBS stock, but you don't have it right away. And then again, in a case like convertible notes, you want to make sure that the way that conversion happens when you do get the equity, that it meets the requirements of original issue debt, and that the capitalization of the company isn't too large. And I'll mention something about that too. That could be another indicator of, could this company be eligible or not? The Big Beautiful Bill increased the capitalization requirement from the limit from 50 to 75 million. What that means is if you're investing into a company that has, let's say, $500 million worth of assets, they'll not likely qualify for the QSBS. You're probably not going to get founder stock. If you see a company and they've got hundreds of employees, even if you haven't seen their balance sheet, chances are just to have that big of operations, they're probably going to have more assets than qualify for this founder stock benefit. So if they've only got a tight management team, maybe a couple dozen employees, if their balance sheet is less than 75 million, that's where you start to see, okay, we're starting to check these boxes. This could be founder stock, and it's worth asking the question at that point.
And like you said earlier, like it needs to be the earlier rounds of funding, right?
Yep. Yeah. Often it's like a series seed, maybe a series A sometimes if it's structured properly. Founder stock is typically structured to be this.
Walk us through an example here. I think most of these deals out there, exit for somewhere in like the low seven figures. But is it as simple as just no capital gains tax or?
Yeah. So on the investor side, kind of coming up with a fictitious example that's based on some real life stories. Let's say that you found a company that does trucking and the founders, they'll be doing all the work. They set up the C Corp. They recognize buying trucks is expensive. And they do a Series seed to raise $10 million, let's say, to be able to then get financing to buy the trucks and do their trucking operation within this C Corporation. And even from the very beginning, they say, we're not planning on paying out dividends. We want to grow this. We want to expand across the states. And then we want to sell this to some big aggregator. So you're like, okay, cool. I'm fine not getting anything for the foreseeable future. I know this is really risky. So you make that investment and they confirm up front that this is designed to be QSBS eligible. So you probably will get your investor communication regularly, but it might not be until, let's say, 5 to 10 years later that they say, hey, we've got a potential buyer, they're private equity, they're going to help us go to the next level of growing our business. They're going to be buying out these certain tranches of investors. And for the other investors, they're going to be buying you out 60%. You'll get a second bite of the apple as we continue to grow. Now that first bite of the apple where private equity comes in, let's say at year 6, and they're buying out 60% of your shares as an investor. Now the company grew, let's say they raised 10 million at first. So the valuation of the company, let's say it was just 10 million right there. But now they've grown the company to 100 million. And let's say that you've got 10% of that. So that 90 million of growth and you've got 10% of it, you've got capital gain, let's say unrealized gain, $9 million. And they're buying 60% of your $9 million appreciation. So you've got capital gains coming your way of $5.4 million. And if you're in Washington State, then that's also going to be subject to the Washington State long-term capital gains tax. Now, because it's QSBS eligible, and when this happens, when they have this liquidity event and you get your check in the mail and you get some tax documentation too, the company should provide you with confirmation, hey, and this sale of your stock was also QSBS eligible. Let your accountant and CPA know. That's where we get really excited as a CPA and we say, hey, you could owe $5.4 million, but because this was eligible QSBS stock and we can report it as such on your tax return, it's not subject to the long-term capital gains tax in Washington. It's not subject to the federal capital gains tax. And that tax savings, for example, between, if you're in Washington State, that could be like a $1.6, $1.7 million tax savings by having that. And in that same situation, you still have 40% of your stock. So as the company continues to grow, you've continued to still have some of your $10 million QSBS limitation available for future capital gains. So that's fairly common. I've seen multiple deals work out like that. I would say they're not simple, but hopefully I threw in a few complexities to give you a real example.
Yeah, and like something that's coming to mind, of course, I'm not giving tax advice, but most of the cool kids out there these types of deals where it's more asymmetric, so higher risk, higher return. Some people earmark this for their qualified retirement plan money because when it does pop, you don't have to pay the taxes on it. But maybe you add in another layer to this is if it's QSBS eligible, you may just use your cash, right? Shield your QRP money or save that for a non-QSBS deal or real estate. Typically, I'm not a huge fan of using it first off for real estate deals because real estate deals already are great tax advantage. But yeah, this is another complication. But I think the only way you learn this is by interacting with other investors and having good tax advisors like you guys out there. Yeah. So I guess like other pitfalls or things that people need to at least talk to some of the risks on this thing or.
Yeah, at least from the tax perspective, and I'm glad that you brought up like a QRP or like investing through your self-directed IRA in this case, because you worry about the UDFI and UBIT leverage issue that you have with syndicated real estate in a 401k or an IRA. So if you did use retirement plan funds, I totally agree. I think this is a better investment that you just hold either personally or it could be through like a family trust. These investments, it's not uncommon for them to have multiple fundraising rounds. So maybe you got your founder stock in Series Seed or Series A, but they might have like a Series B or C later on. And those are going to be a little bit more stable, a little bit lower risk. they're often not going to be qualified for founder stock benefit. So if you want to participate in a later round and double down in your investment, that could be a better case for your IRA or your 401k because you're not going to get that founder stock benefit. The other tax planning suggestion I'd bring up is if you're seeing that this investment's going really well, they are looking to exit maybe in a couple of years, and you're seeing that the valuation keeps going up, you might consider doing what's called QSBS stacking. Now, this takes advantage of the $10 million, or in the case now, the $15 million limitation, which is per taxpayer. Now, if you have a irrevocable non-grantor trust where you've set it up for, let's say, your kids, let's say you've got 2 kids, you set up a trust for each of them, and you move some of this founder stock, you gift it to them, it probably eats into some of your lifetime gifting exemption. But then when the company sells, it's not just a $15 million limitation that you now have stacked the benefit because each trust gets their own $15 million benefit too. So in that case, like you'd have a $45 million tax benefit, about $45 million capital gain that would be tax-free. And the question some people might be wondering is, that's great. I'm happy just to take the money and run. Like at that point, I'm already doing really well. Does that really happen? I would say it happens more often than some people realize, where, like you said, these are very asymmetric. A lot of them will bust, but when they boom, they grow a tremendous amount. There's other ways to structure this. If you've got like an existing business and you want to convert it to a C Corp to start this 5-year clock, if you're thinking like, hey, I'm a business owner, I've already have this business. No one ever told me about this. How can I get this for myself as a business owner? There's a way you can restructure your business. And in that case, if you're rolling an existing business into this new structure, there's something called the 10x limitation, where you can take 10x of your old business value, and that's your new limit. And so that can be hundreds of millions of dollars of tax-free gains when you sell the company later on in a stock sale. So all sorts of complex opportunities here. But again, it's one of the least known about and one of the most powerful areas of the tax code.
When I first heard about this, it sounded like the Rob's rollover business startup. I don't really want to go into that because I think that's a huge rabbit hole.
Complex.
But I guess maybe how's it different? Because it does the same thing, right? For people who are familiar with that.
I think they target very different audiences, because the Robs, you're using your retirement money to invest into a business, an operating business.
Any business, a lot less restrictive than what we're talking about here. Yeah.
Yeah. And so with Robs, I think you're targeting an audience that they could, and what in my experience, like working with clients who've had those, they tend to be investors who don't have much outside of their retirement. So what they're trying to do is they're trying to use most of their investment capital is already in a retirement plan. How do they get a better return on that? For QSBS, it's a different audience where most of their investment capital is probably outside of a retirement plan. And so that's where you get a different audience there. With Rob's also, you still have the business inside your retirement plan. And so eventually when it sells, and you still got to pull it out. So hopefully it's a Roth retirement plan at that point, but you're still paying ordinary tax when you take it out if it was a pre-tax retirement plan.
Something that's popping in my head, like at least speaking for myself, this is a half-baked idea, is like when I am going into a deal as an investor, or in particular an angel deal, I'm definitely going to ask the operator, like, hey, is this QSBS qualified? And I'll probably get that in writing. But if it isn't, at the end of the day, there's typically a reason why they opted to not do an asset sale, or maybe they truly messed up something up in the paperwork through the process. But I know as an investor, I'm not going to really sue them for that because it's in the disclosures. This shit can happen. Like even from taxes perspective, there's things that change that's outside of their control. Or even if they said they would and they tried to do it and it didn't work out, it is what it is. But hey, that's why I'm a good investor. People like me to invest. Not everybody thinks that way. But I guess the takeaway here, folks, is it's a good question to ask coming in, but you can't really hold them to it at the end of the day because things could happen.
Yeah, very well said. I've had some clients with that too, where I'd get excited, like, oh, you've got like founder stock, and they just sold and they get this payout that they weren't ever expecting because they thought it was just they basically took it as a write-off in the past. And they go and they inquire about the benefit, and they find out from the management team of the company, like, oh, we never knew about QSBS, or no, something happened and this isn't eligible for founder stock treatment. hey, at least, you made a riskier investment, and at least you got to pay out. So I think the tax-free savings is icing on the cake.
I keep hearing from high net worth people that one guy was just gave his kid like 6, 7 figures to start a hedge fund. And, what better way to teach entrepreneurship to a kid than have them put skin in the game and you fund them. But if it goes belly up, like it's highly likely to do because it's a new entrepreneur, your son or daughter, then you get an ordinary business write-off potentially. Or maybe it's something like here, right? You justify it if it does blow up to the good. I guess maybe I'm not going to hold you to these, but just to wrap this up, I can see some like limbo land in this stuff, right? Because you're telling me to qualify, this stuff needs to be somewhat risky and creating something new for the country, which is why they're giving you the incentive. But what about I call these hybrid investments? I don't know if that's a real term, but in some of these tech angel deals, for example, you've got like a business that is operating like a SaaS company. It's creating existing revenue. It's actually a bootstrap business, which I think appeals to a lot of people. But they have a new business line where they're trying to create this brand new thing as an offshoot. Does that kind of qualify for the QSBS thing, even though that new offshoot is a small minority of the actual core business? Or tell me where the gray areas are on this thing.
Yeah, that's a good one. And I haven't had that come up with a specific client before yet. And in that example, but my thought is you've got like this really great bigger company that probably doesn't qualify it on its own, but it has its own corporation that's going to be doing development of a new software process, and that could grow. One of the thoughts there is that one of the taxpayer classes that don't get this benefit are corporations. So this really is meant for individuals or like their trusts, or it could be held by a partnership, but that benefit flows up to individuals. So it's nice to see that like corporate America, these giant corp companies aren't getting this tax benefit. It's for individual investors, really. And so in that example, if this big C Corp has a spinoff and develops something and it goes to the moon, it's not the company that's going to get that tax benefit. But if you were tagging along as an investor, and where this could happen, for example, let's say like you're one of the key employees, you're an engineer, you're developing the software, and the company says, hey, we're spinning off this new C Corp that's going to do this one thing. We are going to put some money in. It's not going to be more than 75 million because that would ruin that rule, but we're going to put enough in. Does anyone else want to participate in this fundraising round? Or they could also say, we want to give you stock options. Now it's going to be compensation for you, but when you exercise those stock options, and if it's structured correctly, where you're considered receiving that stock on original issuance, then maybe you do have founder stock in that benefit. So I think there does have to be a little bit of the stars aligning, and there does have to be some thought given to each situation. But I think everyone's situation, especially when you're involved in some kind of business activity or you see something, hey, this could really grow very aggressively over the next 5-6 years, and then I just want to sell it. Those could be situations where I would say, give me a call or email me, and happy to talk it through and see if that could be something that could lead to some QSBS tax benefit.
Yeah. So you don't see people like swimming in the gray area. If they have something that's new and qualifies, they spin it off and they don't try and have it be the ticket to make everything tax-free. Like nobody's doing that kind of stuff. That's just too aggressive.
And I think that when you get to a larger scale, differentiating between like you've got main street size businesses, lower middle market, and then above that you get into like really big institutional deals. The further up you go, they're less worried about, I would say, some of these tax benefits, these tax strategies, and they're concerned more about the overall price. You think about founders of Microsoft, when you've made hundreds of millions, you've still made more enough for all your generations and all your posterity and all your philanthropy needs that what if 20-30% taken off, you still have more money than you ever thought you would ever possible. But what could risk that isn't taxes, but public appearance and stock price, the SEC coming in, and you've got securities law compliance. That's where they start to focus more. So the bigger players, and I've been in the room once where I was talking with the founder and they were looking at IPOing, and we had in the room some people who have a lot of experience with this whole process. And I brought up, what about this founder here? We want to preserve their founder stock benefit. And I kid you not, some people who had a decade more experience than I did on this structuring, they looked around and said, what are you talking about? And I had to pull up the code section and show them section 1202, QSBS, and explained it. And they said, we never deal with this. And In a side conversation after that meeting, they'd said, we never deal with it because by the time it gets to us, it's too big. It doesn't qualify, or people don't care about the tax savings. So mind shift and priorities definitely shift when you get to really big. So I think that's why it's an awesome opportunity for smaller investors, for founders, for people like angel investors who want to invest in these higher risk startups and give them a chance to breathe some life and grow.
Yeah, just an extra incentive. And it reminds me of the Roth IRA. Like for a lot of accredited investors, you don't qualify for that. So that's just not a tool that you talk about a lot.
Exactly. Yeah.
That's a super cool QSBS, not just a bunch of BS. People are interested in working with you on something like this. Maybe give out your information or if anything else you think we missed.
Yeah. The best way to contact me is email. You can reach me at tjones@sweeneyconrad.com. I'm sure you'll post and share that. Happy to share an hour of my time just talking through whatever situation you got. As much as information I could share on webinars or on our website, honestly, the best advice is tailored to your own situation. I've had people come to me and say, how do I save taxes like the ultra rich, like the billionaires? And trust me, like they have a very different set of priorities and situation. We want to save taxes for your situation and tailor it to you now, your midterm plans, your long-term plans. So I'm happy to share some of my time with you, your investors, your friends, and help see what we can do to help you.